Welcome to the daily update, where I'll go over the action in the market for Friday, September 19th, and we'll see how things look for Monday, September 22nd. Okay, another all-time high. It was growth and mega caps that really led things higher. Now, Friday was options expiration. That's kind of its own day in and of itself. It's also the last monthly expiration for the quarter, and so we saw a massive increase in volume and some positive action, at least with the big names and the mega caps. The small caps didn't participate in this one, nor did the mid caps. And we're still seeing some negative divergences. As I've been trying to explain this, it's like the outside of the car is all shiny and the wheels are looking really good. But you go over and you lift up the hood and you look inside the engine, there are some problems. Now, we're not seeing that based on price, and price is the ultimate indicator, so we have to follow that no matter what all of our charts are saying. And we're also now coming a little bit deeper into the second half of September. And historically, the week after options expiration, the second half of September, they have been the worst performing times going back to 1950 that we have. But we were looking for that in July, didn't happen. We were looking for that in August, didn't happen. So far, it hasn't happened in September. We still see sentiment kind of lower. I mean, it's positive, but it's not exuberant right now. That could actually work to the market's favor. A lot of people are not believing that the market should be going up right now, and that's probably why it's going up. But at the same time, some of the smart money is going to want to come in at some point and take some profits. As we get further into the end of September and closer to that, it's also going to be the end of the quarter. So there's going to be some window dressing. There are money managers out there who are going to want to lock in some profits. There's some smart money that's going to want to reposition. So we just want to be aware of these things and know that we're positive, but there are some concerns under the surface. All right, so right at the open, we had a higher open. Futures were fairly strong, not much of a gap though. And we did initially hit resistance at 66.50, and then from there we declined down to the daily pivot at 66.35. And this is a built-in support level on an up day. We found that support at the unchanged level. And then as the day went on, prices rose back above 66.50 and R1 at 66.55, and we closed just a little bit off of the intraday high. So we were up 0.49%, and that's what we've been seeing. Not real big percentage moves. We're seeing, a 0.5% here, a little bit under 0.5% there, and it's not seeing a lot of conviction in that regard, but they are advances, and we are setting all-time highs. We were way above average with volume because of options expiration. We're positive in the short, intermediate, and long term. We're above the 20, 50, and 200-day moving averages. Interest rates are creeping back up. We got down to that 4% level, tested it a couple of times, and now we've been going back up with the 10-year yield. We want to keep an eye on that because at some point, the stock market may notice that and go, wait a minute, interest rates are going back up. We thought they were going down. I mean, they watch this stuff all the time anyway, so they know what's going on. And we saw for 2 days now, the dollar was up, and the dollar going down as we were coming up out of the lows from last spring, that really helps stocks improve, is a weaker dollar. Stocks like a weaker dollar. It's been going back up a little bit, still in a downtrend. We haven't changed any of that, but we just want to keep an eye on those things. And of course, all the domestic and international things that are going on geopolitically, not really having an impact on the market right now, but that could always change. And there's a big event that's going to be happening in Phoenix on Sunday with a lot of people all in the same place at the same time. Massive security. Is that going to go off okay? Now, I'm not a doom and gloomer. I don't wish ill on anybody or anything, but you have to face the reality of a lot of people being in the same place at the same time. I said this at Ronald Reagan's funeral back in 2005. You had world leaders all coming in, they're all in the same place at the same time. Nothing happened, and let's hope that's what is the case this time. But at the same time, we need to be realistic about things as well. Okay, so some comments. The Dow, the S&P, Nasdaq 100, and Nasdaq hit new all-time highs. The only difference in this list from Thursday is that the small caps with the Russell 2000, they did hit an all-time high, but they declined on Friday. Mega caps and growth did outperform, where small caps and mid caps declined on the day. You could say they underperformed. And then we had some Federal Open Mouth Committee statements here. Fed Governor Stephen Moran, who is a voting member, said that he supports 5 rate cuts this year. My gosh, it's Christmas in September. That's what the market would love. Arguing growth will improve in the second half. Yeah, I'm not sure the second half of what. Well, Minneapolis Fed President Kashkari, who's not a voting member, said that he favors 2 more rate cuts in 2025. Now, when they came out with the SEP, the Summary of Economic Projections, it only really focused on 1 more rate cut, but the market's now starting to count on 2 rate cuts. You have Stephen Moran, who thinks there should be 5 rate cuts. My goodness. And right now, there's only looking to be 1 rate cut in 2026, but this will adjust all the time. What we're dealing with right now, you go back a month, 2, 3 months ago, the predictions, they do get changed as we go through all of these events. Okay, now one thing that we don't see very often, and this is a chart that I usually show almost always in the what I call the deep dive video. It's a weekend video that I do where I pull out charts that really I don't use all that much, and there are also some charts just unique to that video. And I call it the deep dive video because we have to look deeper to see, okay, is this telling us anything? Well, this chart has been on that deep dive list now for a while. We've been looking at it, but it hasn't really been saying all that much. Now it's starting to tell us something. And now I'm including it in this video because we're seeing some fear starting to enter into the market that's not being picked up by the VIX. It's not being picked up by other sentiment gauges that we follow, but this is picking that up. And so I'll explain that more when I get to that chart. Now, we are still seeing short-term positive momentum. The usual charts, Stochk RSI, Williams percent R, both CCI charts and stochastics. When we're seeing positive short-term momentum, this is the list that we see. Now, there are some additional things on this list that we don't see as much that give us a little bit more concern. The first part of this chart or this list is that's just showing good conviction. Now we're still getting far away from the 20 period moving average. That's what the boom indicator measures, and the 20 period, that's the short term, and the RSI based on 9 periods is starting to get extreme. These aren't on that list all the time. This is more saying, okay, maybe we're a little overextended in the short term, where the rest of this list just showed, no, that's just showing us positive conviction. Intermediate term, still looking a little extreme here with the standard deviations chart. We're in that +3 channel. And now we can ride that for a while, and we've ridden it before. We're riding it now, but we just want to be aware of that, we don't tend to stay up there for very, very long periods of time, but it's positive. We can ride that for a while. And the Sean trend meter is starting to look extreme. The money flow index, that had been on the list, it dropped off, now it's back on the list. We're also far away from the 50 period moving average, which is the intermediate term moving average that I use. And then now we don't see this one on the list lately very much either. The RSI intermediate term based on 14 periods. It's looking extreme as well. Then we're also keeping an eye on a 200-day simple moving average. How far away is the S&P from that moving average? And we're above the 10% level. Again, there's no magical 11, 12, 13, 14%. We don't use that like an oscillator. We look at that, we're aware of it, and when we tend to get too far away from that moving average, that's when the market is more vulnerable to a decline. But I've been following this now for about a week at least, maybe even longer than that. And so it's not predicting anything, it's just showing us the condition of the market. And then we look at other charts to say, okay, what is looking more vulnerable here that could lead to a decline. And the only thing I've changed as far as the scenario with the Fed is that the rate cuts, the market's pretty much figuring there's going to be another rate cut in October and possibly one in December. The dollar was up, interest rates were up. We did get down to that 4% level. Now we're bouncing back up from that. We're at 4.14%. We're after Thursday. we were at, after Wednesday, we were at 4.1%. And sentiment is still positive, but not extreme. We're at 62. We just ticked up one notch here. This is giving the market a little bit more room to run to the upside. When we get up to 70, and then the closer we get to 75, that's when sentiment is starting to get exuberant, and you see FOMO kicking in, the fear of missing out. Folks are missing out on gains and they're worried about being left behind, so they're going to jump in. And then we see sentiment really going up when that happens. We're positive, but we're not necessarily at that euphoric state, at least yet. And then our trend is positive, both in the short and intermediate term. We have the green line above the red line. They are strengthening trends since they're above their moving averages. And the bias is positive since we had the up day, and the momentum, the last number of days taken together, is still positive as well. We didn't have any economic reports in Friday's session, and we're not going to have any for Monday's session either. So the markets don't have any kind of reports to key off of. Now we're going to get some bigger reports next week, and I'll go through those, but there's not anything coming out on Monday. So there's no charts to show there. Now, this is put out by Real Investment Advice, consumer confidence and higher stock prices versus trailing valuations. These are earnings reports that have already come out. And I do another video over the weekend called the Intermarket Analysis video, where we really try to break down valuations, both on a historical basis, looking at earnings reports that have already come out. That's called trailing valuations. And then we look at forecasts moving forward. And that's what the stock market uses to key off of. And you can see there's a pretty strong correlation. When the red line's going up, this is the trailing operating PE ratio, and that's been going up here. And the stock market, of course, the confidence level has also been going up as well. And not a real surprise there. They tend to move more hand in hand. If the stock market's going up, people are more confident in that. All right, and then this tries to break it down on a seasonal basis, looking at historical data. It says the S&P 500 around the first rate cut following easing cycle pauses of 6 months or more, and that's what we had. The Fed had not been raising rates longer than six or shorter than 6 months ago. And so how do things act? And this puts a lot of things together, and it does look positive going forward. At the same time, we want to know the context of why is the Fed cutting rates? A little bit of weakness coming into employment. They want to juice up the economy a little bit. And so that kind of a rate cut is taken as more positive. If the economy's falling off a cliff and they're cutting rate cut or they're making rate cuts because we're having some real problems and employment is looking really bad and everything is looking more negative, that's a whole different context. Right now, we seem to be in a more positive context for things, and that's why the market has been reacting positively, not only to the rate cuts that happened, but the hope of further rate cuts as we go through 2025. And concentration of the S&P 500 market cap and earnings in the 10 largest stocks, 40% here with the market cap and earnings are 30%. That's why I show charts of these companies. That's why they're the main stocks that people talk about, because when they move, the stock market moves either up or down with them. Then S&P 500 cash spending relative to cash flows. This just gives you an idea. And there are buybacks that are starting to come back in, where a company goes out and buys their own stock. That's taken as positive. Dividends, you don't see those as much with common stock. It's really preferred stock that pay more dividends. And so, but there still are companies that do pay dividends, and a lot of investors like to make their decisions about, hey, the company's making profits, and I'm going to make a little bit of income from that in the form of dividends that are passed on to shareholders. And then CapEx. These are capital expenditures that are actually going into the company, and this is also up really high right now and is seen as positive. If a company's willing to take their cash and dump it back into what they believe is happening, especially when it comes to AI, that is taken as a positive thing. All right, and then I'm recording this after options expiration, so this might be a little irrelevant, but it's just this is why we saw the massive amount of volume in Friday's session. These are all the options that are getting ready to expire, and it was 5.1 trillion in option notional that expired. It's already gone now, but this is what it was like before we opened, and there's an AM settlement that's for European style options, and then there's a PM settlement, which is more the American style that you can still go with those until the market closes. They really don't expire until Saturday, but the last trading day is on Friday. And this just shows you why things can really gyrate and why I call options expiration, especially at the end of the quarter. It's its own beast because you've got all these folks out there having to deal with these things to see, are they making money? Are they losing money? If they sold options, are they in danger? So there's a lot of positioning that can go on because of that. Then foreigners bought a lot of stocks while households and hedge funds sold. All right, so we got some folks from outside of the US doing some buying, but we're seeing households, individual investors mostly, folks that have retirement accounts, and hedge funds ended up selling. Okay, then the U.S. rally powers global stocks to fresh highs. When the U.S. is doing good, the rest of the world is doing good as well. But still, the U.S. markets in 2025, when you look at the S&P and compare it with Germany and compare it with emerging markets, it's still continuing to underperform. But it's still positive nonetheless, and still is the main leader. All right, this is a different source here. Quantitative easing distortion. Quantitative easing is the Fed directly growing monetary base. This is what was happening during the COVID, um, when the economy was just non-existent, and the Fed came in to try to prop it back up. Then, when they get done doing that, there's quantitative tapering. That's when they're taking that money out that they were using to stimulate, realizing that 20 years ago, the Fed said, "Oh, we'll never do this." Well, they did do it during the great financial crisis, and now it's an expected thing that the Fed is supposed to do. And if you're a pure free market capitalist, you don't want to see this going on, but it might help your overall portfolio, so you might be more willing to accept it. But okay, so it grows the monetary base. That's quantitative easing. They're basically adding currency, and it's not like they're using printing press that are churning out bills 24/7. It's all digital. This complicit with a rising Fed deficit, and we're still going up a lot as far as the deficit with the Fed, and then holding the base reserves at the Fed and by paying interest because interest rates have gone up, so that has to be paid for. This inflates financial assets, but not real growth. So you take all of this together, and things are going up, but not necessarily because they are growing here. Okay. Then IPO activity looking fairly strong. That's what typically happens when the market is more positive. You have these private companies that want to take their stock public, and the first day that they trade, that's called an IPO, initial public offering. And companies tend to do that when things are more positive. Retail favorites, the Goldman Sachs basket of stocks widely held by the retail community is going straight up and to the right. That's over here on the right-hand side here. Poised for a record 10th straight day of gains. Well, it probably had those again. That would be 11 because this came out before. I'm not sure when this came out, either before or after the close. It's up over 13% over this stretch. Okay, not sure what they define by a stretch. All right, and then AI versus non-AI margins. Without the robust growth from AI, the S&P would be much less exceptional in both terms of performance and growth. That's the darling spot right now is AI, and AI stocks are benefiting from that. Where if we look at all of the rest of the stocks, it's been not negative, but not really showing much upward movement either. All right, here is the chart. We had a higher open. We just about got up to R1. We got up to this 6650 level, and then we came all the way down. We hit the daily pivot. We came down, touched the unchanged level. That acted as support. And then after that, we bounced back up, got above the 6650 level. We're able to get back above R1. We never made it up to R2 because the pivot points for Thursday were pretty wide after Wednesday was really, really wide. So we're still having to calculate these things here. And we actually set the high going into the close, but we were down just a little bit from that. But it ended up being a positive day. And things are pretty quiet as we're getting ready to shut things down for the weekend. Still looking okay here. The blue line and the red line, they're about equal with each other on the growth to value intraday chart, but they're both going up. and that is taken as positive. This is also improving. The S&P intraday growth to value ratio, we're above the moving averages and improving after we have been going sideways here for the last number of sessions. So on an end of day basis, growth was up more than value for the large caps, and that's helping that area with growth to actually outperform. And even though the mid caps were down, it was down less for the mid caps with growth than it was with value. It's down just a little bit less with the small caps. So we've been a little bit concerned about this with small cap growth to value. We've been going up with the index, but we've been seeing this ratio going down, and that is a negative divergence. You typically, as the index is going up, you want to see this ratio going up as well. A little bit more positive here. We're actually breaking out when we look at mid cap growth to value. So that had been looking weaker, but showing some improvement. And we're still below the 50-day moving average with the growth to value ratio for the S&P. We're in an uptrend though, but we're not seeing a lot of real upward thrust right now. That's the same thing is true here with the S&P going up. We want to see this ratio going up as well. And we are doing okay with this growth to value ratio. We're finally breaking out above this previous high. Large cap growth looking pretty good, setting another new all-time high. And this ratio going down is positive. This is value to tech, and we break that out in that's one of the growth areas. And this ratio is actually more positive for the market when it's declining. Still looking pretty good here with discretionary to staples. This has been one of the stronger areas of the market. As discretionary has been going up, it's leveling off lately. Where we're seeing some weakness are in the staples, and that's a more defensive area, and this has been trailing off here. But overall, the ratio is going up and looking positive. So our trend in the short term, positive. We're above the moving average. We're going up. We're in a trending situation since we're above 20. We're positive with the green line above the red line. Same thing here with the intermediate term trend. Above the moving average, green line above the red line, also above 20. And we saw a huge volume spike because of options expiration. You can see, woo, big time move there. All right, and then this is another newer chart. This is gamma exposure. And we use options. And gamma is one of the Greeks. There's delta, theta, vega, gamma. It's like you're on sorority or fraternity hill here. But it says the flip point is 6480. You could round that up to 6481. And the area that I've been watching for support is 6486. That's on the weekly chart. And so these are kind of coming together. And that's why now, and when I get to that chart, I'll show you the weekly chart of the S&P. We've now been above this 6468 level long enough. That's a pivot point. We're now starting to call this support because I had just been saying we're above overhead resistance. So this is kind of coming in to see if this is more important. And then we're looking at the put wall at 6,600. That's underneath current price. The call wall that could be acting as overhead resistance is at 6,700. And you can see here, there's a lot of gamma exposure at 6,700. We're even starting to see it picking up at 6,750. So usually when this is going up and this blue line and then this column intersect with each other, that's kind of giving us a more critical point using this method to analyze support and resistance. And still not seeing an awful lot of fear with the VIX, both with the line chart and bar chart. So not seeing fear here. And we're not seeing any seasonal fear coming back in as it applies to the VIX, at least yet. And we're actually coming down to a little bit of a pickup. We're above the moving average with the VIX of the VIX. This is the volatility of the VIX. So, but it's not really skyrocketing either. This is the chart. And I look at it every day, and it can go a long period of time and not tell us anything. But we look at a correlation between the VIX and the S&P, and we're up above this dashed line. Now, we don't know if we've topped out yet. We go up, and at some point we top out and then start coming back down. Look at other times when that happened. Now, sometimes not much happened, but a lot of times we would get a high reading like this once it's finally finished, and that would end up marking a decline after that. You can see I have the red line here, and then we saw a decline. Red line, decline. Now here, we kind of went sideways and then went up. So it doesn't mean that this is magical and is going to always predict everything. But a lot of times when we see real high readings here, other times it was a continuation. This actually marked a bottom, believe it or not. So, okay, we don't want to just base everything around this chart. We just want to respect what we're seeing here and see, okay, this is giving us a warning sign that we weren't getting before. Let's pay attention to it and then see if it's confirmed by other charts. And we're going up with this fear gauge a little bit, and we went down. No, we went up with this other fear gauge. A little tick up there, not really much of a change because the broader market was not all that strong. And you'll see that as I go through some of the other charts here. But we are going up, not as much as we were with the risk on to risk off ratio, but that is positive. And we saw a real drop off with the daily equity put call chart. We're actually dropping below the red line now with the 5-day chart. This means we're starting, this is kind of a sentiment gauge, meaning that we're looking to get extreme positive when we're getting a really low reading like this. There's not much hedging going on right now. And this is also declining. I'm taking this more as positive. It's longer term, and we don't have that real range that we see with the 5-day chart. And a little bit above the band here, but just kind of going sideways. So we're not seeing fear with these other fear gauges coming back into the market, but we're seeing it with the VIX to S&P correlation. So that's why I kind of keep that chart in the background and then bring it into the video when it is telling us something. All right, and even though we set an all-time high, we were down with the advanced decline line based on price and volume. That's not falling apart, but you would expect that to be confirmed with an all-time high with the S&P that this would actually be going up and it's actually going down. But longer term, it is positive. And we're actually dropping a little bit below the midpoint in the short term with the advanced decline ratio. So we're a little bit below zero here based on price with the advanced decline ratio, but on the positive side, we're still above zero when we break this out based on volume. And the advanced decline oscillator just not, it went down, but it hasn't been showing an awful lot of conviction. We've been hanging out right around the midpoint for quite a while. And we did see a nice healthy new highs, but not enough to turn the 5-day chart up. And we were flattening out and going down ever so slightly with the 10-day chart. So we're not seeing a lot of robust strength right now internally in the S&P. Now this is looking good though. This is a smart money indicator and we're above an advancing moving average. We're above the shorter term boom indicator, which is just a modified MACD. This is positive. And we're also back to positive again with the Chaikin money flow. The red line is now going up, and we turned it back up with the Chaikin oscillator, and we're back above the moving average. Where we were seeing more negativity with our smart money indicators, now they're all back to looking positive. And the vortex is positive. The green line is above the red line. This is longer term, a 10-day moving average of the highs and lows for the S&P. We're below this green line, and we're continuing to decline here. And that's longer term negative, just showing some weakness that's getting picked up. And we're still above the moving average with the advanced decline line studies with the common stock on the NYSE, just barely above it here with the S&P. Where we're seeing a little bit more weakness is with the mid caps. It never did get back above the moving average. The small caps, when they set a new high, they got above the moving average only to drop below it again on Friday. And this is another broad market measure of a 5-period moving average of the highs and lows. This is looking pretty good. So you look across the broad market and it's looking more solid. You look inside the S&P, we're not seeing an awful lot of internal strength right now. And as shown here, the stocks in the S&P above their 20-period moving averages, below 50 and declining. That's actually negative now after we've been setting an all-time high. This has been going up. I've also been trying to point out these series of lower highs that we're seeing here. That's longer term showing a negative divergence. And we're still looking okay with the 50-period moving average study. We actually declined a little bit with the 100, and we were flat here with the 200-period moving average study. It's mostly in the short term where we're potentially seeing some vulnerability here, but we're setting all-time highs. Now we're below this dashed line, which is a pivot point. We'll see if that ends up providing overhead resistance, and we were really above average here with volume. We actually ticked down a little bit. We're right above 50. The 50 level is the line between positive and negative. We're at 50.4 here with the 20-period moving average and little kind of sideways above 50 with the 50-period moving average declining, but still above 50 here with the 200-day moving average study. Then we look at our short-term conviction charts here. The Stochc RSI, that is looking positive, as is the Williams percent R. CCI 14 chart is above 100, and the CCI 20 chart is above 100. And we're turning back and looking positive with the short-term stochastic, turning back up an extreme positive with the intermediate short term, and still kind of flattening out, but giving us a positive reading here with the long short-term stochastic. And I say that because this is a further subdivision of the short-term time frame. Positive with the force index above the midpoint and green. Looking good with our 20 period moving averages as based on a double and triple exponential moving average study. The price is above both the green line and the blue line here, and the lines are going up. And here's the +3 channel with the standard deviations chart. And you can see we rode this back earlier in the summer. We just hung out here for quite a while. We've been up here for a few days now, but at some point you got to think, okay, are we getting a little overextended? Intermediate term, after we saw this go down on Thursday, it actually bounced back up and is looking more positive with the balance of power after Friday. Still extreme with the CMB composite. I use this like an oscillator. That's suggesting that maybe we're overextended in the intermediate term. We are positive with the dark blue bar with the go, no go system hitting the blue line up here. That's the highest high value, and the midpoint's going up, the blue line's going up, the red line's flattening out. That's looking pretty positive. And we're on day 98 of the Landry Light trend system here that kicked in all the way back to the beginning of May. Also a little further into May, but the proper order is also still in an uptrend. Still positive with the TTM squeeze, lighter blue bars, and advancing. And still just hovering along, slightly positive here with the ease of movement. We're positive with the Arun, since we're above zero with the oscillator, still showing that buyers are outnumbering sellers. That's what the oscillator tries to measure. But then you look internally inside the S&P at the McClellan oscillator, we actually declined. We're setting an all-time high with the S&P, and this is going down and actually below zero. Also seeing longer-term negative divergences here as we've been coming up. This is part of the weakness and negative divergences that I've been talking about. So we're still declining with the S&P based on price. We're going up based on volume, which could be positive. When volume is positive and price is negative, quite often what can happen is that we see volume start to pick up price and turn it more positive. But we've seen this for a few days now and it hasn't happened yet. And now we have been holding up a little bit better with the broad market, but we dropped back below zero with the NYSE McClellan oscillator. This has been really choppy lately, not really showing an awful lot of conviction with the summation index based on price and volume, just kind of floating along sideways. And we're getting another mixed picture here. We're starting to turn back up with the Swanland trading oscillator based on price, but we're declining here based on volume. And momentum, though, is positive. The PMO above the moving average. We're actually seeing a little bit more weakness here based on price. We're falling further below the moving average, where we're trying to tick above the moving average based on volume. And so then we have all these studies inside of the S&P, all the PMO studies here, not really looking all that great with the PMOs that are rising. We're below 50. We're trying to turn back up, but also below 50 with the buy signals, and we're declining, but still looking pretty solid overall with the PMOs that are above zero. Then the momentum, this is short term. The slope oscillator is above its moving average. That's positive. We're positive with the MACD. So you look at all these different oscillators, short, intermediate, and long term, they are switching over and looking positive. And the copy curve momentum oscillator is positive, but we're getting extreme here with the Sean trend meter. Go back and look at other times when we hit this dark green area. Didn't necessarily mean a reversal, but it could mean some kind of a pullback. This actually did feed into a pretty more substantial decline. This was the mess that was developing in March and then into April earlier in the year. And we're looking extreme here with the money flow index. We're back above 80. We are going up above 50 with the ultimate oscillator. We're positive with the unbalanced volume. Starting to get extreme in the short term with the RSI based on 9 periods, and now we're getting extreme with the intermediate term RSI based on 14 periods. Positive with the Elders impulse system for the S&P, positive with the parabolic SAR, positive with the short and somewhat intermediate term trend here based on 10, 20, and 30 period moving averages. And above the lines here, the intermediate term trend based on 50 periods. The red line and blue line are going up and price is above both. That's positive. and we're above all the moving averages here with the moving average lines going up. But we are getting far away from the 20 and 50 period moving average. That's what the boom indicator tries to measure. Since when we get too far away, it's like the moving average will act as a magnet or a rubber band and price will have a tendency to snap back. But these readings can go on for a while. And we're getting further above that 10% level. We're now actually above a little bit above 11% distance away from the 200 period simple moving average. And again, there's not a magic level here. It's just other times back in 2023, it happened twice in 2024 when we got more than 10% above the 200-day simple moving average and then we hit an overbought condition. That's when we saw a more substantial decline. We're wondering if something like that's going to play out this time. We're just watching this, not predicting anything, just watching to see how this unfolds. And not much of a change, but leaning a little bit more positive with the bullish percent index for the S&P and chopping, kind of not really showing conviction here with the NYSE bullish percent index, but it's a positive since it's above 50. And we leveled out and we're actually positive above 50 here with the NASDAQ 100 bullish percent index. This is the longer term chart. I'm now going to start calling this support. We've spent a few weeks above this R1 pivot point after we spent like 3 weeks below it. We were finally able to break through it and go above it. So if we do start to decline, this is the 64.68 level. Now we're at 66.64. So we've got a couple hundred points to play with here, 180 points or so. But if we do start to decline, we'll be seeing if this ends up providing any kind of support. But this is a good looking chart here with higher highs and higher lows. These are weekly bars. We are getting above this upper trend line here. We did that before, but then after that, we didn't have a very good 2022. So we'll see if this is providing overhead resistance as well. But on a trending basis, we're looking pretty solid right now. The Heiken Ashi, Kegi chart, Renko chart, three-line break chart, positive. Long term, not really seeing a lot of upward movement here with the 150 and 200 period moving average studies, but they are positive. And this 200 moving average study, this is different than the study I was just showing being further than 10% away. This is developed to look more like an oscillator. All right, positive on all time frames across all the different indexes. Dollar is negative across the board. We've actually switched to long-term negative with bonds based on price. So we saw tech, communication, and discretionary. Those were up, and that's when the market is more positive. Utilities had a okay day. They finished in second place, but they a distant second over here, where we see energy, staples, healthcare. These are the more real estate. These are the more defensive areas, and they ended up being down. And this is why growth outperformed value. So Canada, another day, another new all-time high, setting a new high with the Nasdaq, Nasdaq 100, and S&P, and the Dow. And the Nasdaq got above 22.5 there. But the real estate sector, which is more defensive, is seeing a bearish MACD crossover. And a lot of green over here in the growth areas. In the tech areas, communication areas, the big stocks, Oracle bounced up back a little bit here. And then we see a lot of red when we're looking at more of the defensive areas. And the equal weight, where we're going up with the S&P, we came down a little bit here with the S&P equal weight version. And then we're seeing a non-confirmation here with the Dow setting another new all-time high. That's not being confirmed by the transports. It's not being confirmed by the utilities either. And if you're a Dow theorist, this is a concern to you. And then we swap that out. Instead of using the Dow, we are setting a new all-time high with the S&P and NASDAQ. So that's more confirmation. Instead of using the transports, we look at the NASDAQ instead to kind of go with the shifting economy. And then this breaks it down a little bit more. We're not setting a new all-time high here with the S&P equal weight, even though we're looking okay. But we are setting an all-time high when we break this out with the QQQ's equal weight. So that is more positive. And we have the Dow it came right up to this R1 point here. That's about where we topped out. Is that going to be significant here? We did close up. We did set an all-time high. This is a pretty good looking bar pattern, but can we get above this R1 pivot point as overhead resistance? Positive with the diamonds looking at the Elder's Impulse system. Now we did break above this R2 level here with the NASDAQ, and that's positive. And we are setting new all-time highs here. Excuse me, setting all-time highs here and a pretty healthy looking bar pattern with this chart. We're positive with the Elder's Impulse system for the Nasdaq. Now, notice how we came right up to this R2 pivot point for the NASDAQ 100. It has not broken above this overhead resistance. And I have found, using this for many years, that the pivot points, either for the NASDAQ or the NASDAQ 100, they tend to be pretty important. They're important for everything, but they tend to really be important for the NASDAQ 100. So we want to watch this R2 pivot point. And if we start to go down with the NASDAQ 100, is that going to take the S&P down with it as well? If we break above this and keep moving up, is that going to take the S&P 500 with it to the upside? Because the Nasdaq 100 stocks are also in the S&P 500 stocks, in the S&P 500 index. Positive with the Qs, Elder's Impulse system. Positive with the momentum for the Nasdaq 100. Above the long-term trend line with the Nasdaq 100 weekly chart. And we came back down here with the small caps. This is the S&P 600. It did not set a new all-time high on Thursday, where the Russell 2000 index did, and it was down also in Friday's session. Still positive though with the Elder's Impulse system. Now this is based around the IWM, which is the ETF for the Russell 2000. And mid caps just kind of floating along sideways here and going from positive over to neutral with the Elder's Impulse system for the mid caps. Setting a new all-time high though with the Wilshire 5000 and the total US stock ETF. That's positive and that's broader market. Financial sector was up, still above its 50-day moving average, but continuing to underperform when compared to the S&P. The FANG index, this is where the strength came from on Friday, so this is setting a new all-time high. So Apple was up over 3%, working off of a recent golden cross. Amazon virtually unchanged, but was up 0.11% above its 50-day moving average. And Microsoft up 1.86%, breaking back above its 50-day moving average. And we're up over a percent here with Google. And when you see a lot of these stocks going up, that's why the S&P is going up. Where we were down just a little bit here with Meta and getting back up to the 50-day moving average is Nvidia. And Tesla was up over 2% again. And that's helping the discretionary sector. Netflix kind of hanging along its 50-day moving average, but it was also up. Now, I usually show this in the weekend videos and other videos, but I wanted to show where we look at a growth to value ratio, semiconductors to the Dow. Now, the Dow does have growth components in it, but it's considered to be the best of the best, the blue chip index. And so it's considered to be having a lot of value. Well, we had been improving here with the semiconductors to Dow ratio. Now we're finally breaking back above this blue line. That means the semiconductors are outperforming the Dow. And when this ratio is going down, staples to tech, that is positive, and still looking fairly solid here with the short term and longer term correlation of US to world stocks. And we were down. We're getting a little bit into the lower end of the 60 range when we look at oil. And we did bounce up with the dollar, but on the daily chart, and you'll see this in the weekly video, we continue to be in downtrends here. And we are going back up with the 10-year yield. See how we came down to this 4% level here? It comes in at 40 here, but that's really 4%. We came down, hit it, came back down, tested it again, and now we're going back up. If interest rates continue to go back up, is that going to pressure stocks? And this is the 10-year based on price. And looking at our growth to value ratios, looking pretty good here though, with the Qs to S&P. We're still above the advancing moving average with discretionary to the S&P, even though it declined, and we are looking good when we compare large cap growth to large cap value. So we're above the moving average with the large caps. Mid caps are showing some strength here. Not really seeing it in the index, but we're seeing a real improvement with the growth to value ratio. And we're still above the moving average when we look at the growth to value ratio for the small caps. And this is another ratio. When it's going down, that is positive. This is staples to the S&P 500. So we are still positive on all time frames and we're above overhead resistance. I'm now starting to call that support. We've been up there long enough. Now we may just slice right through it. Maybe we haven't been there long enough. We'll just be watching that level with the pivot, weekly pivot point. And we're not going to have any economic reports on Monday either. And then anything geopolitical, and let's just hope everything goes okay over the weekend. And here is the economic calendar for the upcoming week. And the big things are really going to come out on Thursday. We're going to get the third look at GDP. So again, it was positive last time, but it was GDP was revised up and the inflation component was unchanged. Is it going to be revised again? And we're keeping a close eye on initial and continuing claims. The big day is going to be Friday. That's when we get personal income and spending and the core PCE, and then consumer sentiment is going to be coming out as well. And here's also a look at the economic calendar for the upcoming week. With nothing happening on Tuesday, excuse me, on Monday, the big things are going to be happening on Tuesday. I don't put as much important into this. This comes from investing.com, and they think that this is an important report, but it doesn't seem to have much of an impact. Seasonally, though, we're now entering the week after options expiration. We tend to be down more than up. We're up 45% of the time, down 55% of the time, going back to 1980. And when you look at September 22nd, going back to 2002, we are negative across the board. Now, it doesn't have this at zero. It was really negative for Friday's session, and we had an up day setting all-time highs. So it doesn't necessarily mean that it just means historically this has been a negative day. And this is where we're entering into the weaker part of the month that we haven't really seen materialize yet, but this is the weak seasonality that we've just been watching for here. This also shows how September is negative, as does this particular chart. I've been showing this for a while. The second half of September historically has been the worst performing half a month going back to 1950. This also shows seasonal weakness that just has not happened yet. This also shows how going back to 1950 how the S&P doesn't perform very well. Tell that to 2025. So on the warning side, though, we still have a pretty short list of negative things, but the things that are on here are kind of critical. We've got the NYSE and S&P, McClellan oscillators, and summation indexes. That's where we're seeing the internal weakness, especially with the S&P. We're getting a mixed picture here with the Swindler Trading Oscillator. Then on the positive side, we still our list is longer here. Our smart money indicators are now all looking positive. We're positive with the growth to value and discretionary to staples ratios, parabolic SAR, momentum oscillators, the bullish percent indexes across the S&P, Nasdaq 100, and NYSE. And then they're in white here. They're secondary indicators, ease of movement, money flow, and ultimate oscillator. With the money flow just starting to get a little extreme positive. Then the gold, that means it's a primary indicator, in my opinion. The vortex is positive. We're positive with the momentum of the NASDAQ 100. We're still positive with the financial sector, but it continues to underperform the S&P 500. And then I'll do this in the weekly videos as well, the long-term special K chart. Both the daily chart and the weekly charts are positive. So here are the pivot points for Monday's session. They're on the website, which you're more than welcome to check out if you're on YouTube or Rumble listening to this. And so this is also put on the YouTube community tab as well. So our conclusion, we're positive and we're above overhead resistance, which now we're starting to at least refer to as support. We've been above it now for a couple of weeks. In the short term, we're seeing positive conviction. If we do start to fall, we'll be watching the 20 period moving averages, but we're far away from them now. But that will be the first layer of fairly significant support if we see a decline. And we're positive in the intermediate term. We're seeing some things that are looking better. I mean, we're setting all-time highs, but we're also seeing some weakness developing, and this is producing some negative divergences in the intermediate term. We are positive in the long term, but we're getting still above, we're 11% now above the 200-day simple moving average. Thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.